Topic about money. Yes, ma'am.
I have a question about like IRAs and like what types of accounts you should go in or mutual funds.
What a great question. That's a good place to start. I'm supposed to put these in here, I think. All right. Here's where my visualization skills have to come in. There are thousands and thousands of different investments, but there are really, if you break it down, only 3 ways to invest money. There are only 3 ways. One way is pre-tax dollars. That's way number 1. So like an IRA, a 401k at work, if you're going to be a teacher, it's TRS, the Teacher Retirement System. Money goes into the account. You get a tax deduction for putting it in there. I contributed $5,000. I made $50. Of that $50, I only have to pay taxes on $45 because I got a $5,000 tax deduction. That's one way. Types of accounts that fall into this category is a traditional IRA, 401k, 403b, which is just like a 401k if you're a nurse. You may end up with a 403b. TRS. Those things are what fall into the pre-tax category. Now you also mentioned like mutual funds. A mutual fund is a type of investment. It is not a type of an account. Think about it like a checking account. You open a checking account, you put no money in it, you just have an empty account. The types of investments that go in checking accounts, it's just cash. It's the kind of investments that the account holds. IRA, same thing. You open an IRA, you put nothing in it, doesn't matter, you still have an IRA account. There just is nothing in it. You put money in it and you decide that money needs to go into stocks, bonds, mutual funds. Those things are types of investments. They're not types of accounts. These things listed here are types of accounts. Pre-tax is one of the 3 ways that you can invest. Make sense so far? The second 2 ways are both after-tax money. After tax, and when you ask for the money back, that's the important part about these next 2. So like, you put money in the account, you wait a year or 2, something comes up, you need to buy a new car, you're ready to move, whatever. You say, give me my money back. When you ask for the money back, it either comes back tax-free or partially taxed. Tax-free are things like a Roth Ira. Now, I think they completely misnamed this type of account because they stick IRA after it, so people get confused. They're like, oh, wait, I thought I had an IRA, and that gives me a tax deduction. Roth IRA doesn't. You put money in, you get no deduction for putting it in. But when you ask for the money back, there are no taxes to receive the money back. Up here, you must pay taxes when you get the money back.
Will you lower it?
You must pay taxes when you ask for your money back from a pre-tax account. With a Roth IRA, you have no taxes when you withdraw the money, but the trigger is you must wait until you are 59 and a half years old in order to withdraw it. The IRS defines retirement as 59 and a half. So if you put money in there when you're 27 and you want to pull it out when you're 30, there will be a penalty for doing that because you're not 59 and a half years old. The other way is the way that I typically have most young people start, because though there is a small amount of taxes as you put the money in and take the money out, there is no age restriction on withdrawal. So it's just a basic investment account, basic brokerage account. Those kind of things like, well, I put in $1,000, it grows to $2,000. And now I want the $2,000 back. Well, 1,000 plus 1,000 equals 2, right? Your original money, you put in after taxes, no problem. You put it in, you take it out, no big deal. But the growth of your investment, however, is currently taxed at 15%. So you owe $150 in taxes off of the gains of your money. But the positive there is there's no age restriction. You put the money in, 6 months later you want it back out, it's no problem. On the flip side, you get a tax deduction if your investment loses. If you invest $1,000 and now it's worth $500, you get a $500 tax deduction for the loss. In the other two types of accounts, you don't take tax deductions, gains, and losses every year. Only when you withdraw it in retirement as a retirement type account do the taxes come into play. So only three ways to invest money. Pre-tax, after tax, that goes in a retirement account that you can one day withdraw tax-free, or after tax money that you can withdraw anytime you want, but there will be taxes on the gains along the way. Does that make sense? Good? Yes, sir.
Yeah, what are those partially taxed funds? Oh, those are
It's the name of the tax is capital gains tax. The current rate is 15% unless Congress does anything. It will go to 20% next year. And inside of that account, then you have to start choosing investments, because investments are what have gain and loss. Accounts have no gain and loss. Investments have gain and loss. So you put $1,000 in an account and you decide to buy IBM stock. That $1,000 worth of IBM stock, the stock grows, the price doubles, so it's now worth $2,000. It's the investment that makes a gain or a loss, not the account itself. An account is just a holding tank for the investment. Now, a lot of people talk about my account as a whole got a certain rate. My account got a 10% rate of return. What that means is all of the investments in the account, if you average them all together, it got a 10% rate of return. But an individual investment is what actually makes a gain. An account itself doesn't make a gain or a loss. It's the investments that you use inside of the account that go up and down. So every retirement plan gets some sort of acronym or number in front of it. So for companies, it's 401k. For a lot of hospitals, it's 403b. For teachers, it's actually 501c3, but they just call it TRS. It's the acronym that they give it. For TCU employees, it is also a 501c3. So that grouping of numbers and letters is simply the tax code that the company must deal with. So the actual name of the account really doesn't matter much to you. Whether it's called a 401k or a 403b or a TRS, doesn't really matter much what the name of it is. They will have some sort of, in your case, almost every hospital will have some sort of a retirement plan that they offer to employees, and you choose to participate or not. Those type of plans are a pre-tax plan where money comes automatically out of your paycheck and into your retirement account, and you get a tax deduction for the money that goes in. But the actual name of the account, it doesn't really matter. From teachers to corporate world to hospital world, doesn't really matter what the name of the plan is. They all essentially work the same.